Hi, Realty and XT viewers. I'm your host, Kritika Singh Rawat, and in today's episode of Let's Talk Business, we have a remarkable guest with us. He's known Ashish Khandelia, who has left a significant mark in the realm of finance and real estate. As the visionary founder of Certus Capital, Ashish has been at forefront of innovative real estate financing solutions. So in this episode, we will delve into his journey and the need gap that gave birth to his company, Certus Capital. We will explore his insights on the evolution of financial investment in Indian real estate market as well as his recent investment in Akasa Premium Residential Project and gain some insights from his perspective on the situations like ICI Prudential 360 Private Equity Fund. So join us as we engage in a conversation that explores his journey, insights, and perspectives, all of which are shaping the future of real estate investments. Thank you, Ashish, for joining us today on Let's Talk Business by Realty NXT.
Thank you so much, Kritika, for having me here today. So look forward to it.
So before we begin and before we dive into the finance of world of real estate, let's talk about you. Let's begin to know about your journey, how and where the origin story of Certus Capital started, and what made you notice in the market the certain need or the gap that you thought this is where you want to begin the Certus Capital journey.
Yeah, so we started Certus Capital about 5 years ago now, in the middle of 2018. And honestly, I think it was a little bit in the building while I was at my previous job, which was at KKR, right? So I will just rewind back before coming to Certus Capital and what led to it. So real estate is not something that I decided to do when I was in my college or when I started my first job. I had actually absolutely no idea that real estate is a sector that will become my profession. So I was just a finance professional. I'm a chartered accountant and a MBA from ISB by education. And after that, I just started as a generic investment banker with Ernst& Young, moving on to Kotak. This is way back in 2004, 2005. When that happened, incidentally, that time period coincided with when real estate sector was opened up for foreign direct investment. That happened in 2005. So while being at these organizations, we started doing some transactions that happened in real estate as a sector. That was quite intriguing. It was a new sector. There wasn't much information about it. When we were at Kotak, we tried to reach out to our partner Goldman Sachs as to how it is done globally, started scouting for investors who, most of these guys, including the Blackstones of the world, were not present in India. So it kind of started that way. One of the first deal that Morgan Stanley did in India, I was the investment banker on that from Kotak side. They closed that transaction. They didn't have a team in India. So they said, okay, now we have done this deal. You any which ways were involved in this deal. Why don't you come on this side? And then that is the time when I actually became a focused real estate investing professional. So that was an interesting journey. We went through our own ups and downs. The GFC happened, changed the whole sector in a meaningful way. A lot of investors came in a very short period of time and also exited in a very short period of time. And we were doing a bunch of things. We were doing operating companies like Oberoi Reality as a pre-IPO investment. And then I think suddenly a lot of things changed. Suddenly things started becoming more defensive. People wanted to do structured finance. That's what we started doing. And then came the opportunity where actually KKR and GIC, they came up with this idea to build a specialized real estate lending platform for in the form of an NBFC. And I thought it's a very interesting idea. I mean, I was in the mid 30s at that point in time. And I thought it's a great opportunity to work with these great organizations and build a platform which is just a business plan right now, right? So that's how I kind of moved to KKR in 2013. And over those 5 years, we did about $1 billion. And suddenly, again, the sector became very hot. Like, as you would know, that between 2016 to 2018, before IL&FS crisis, it was an extremely hot period where too much money, too much debt capital was chasing it. So that was a good experience in terms of when you can move forward fast and then when you have to step back. But in over this 10 journey between these two organizations, I did realize one thing, that foreign capital is still mostly suited for buying assets in India. They're not that much there for development. In India, like if we do 40, 50 million square feet of office in a year, we do about 350 million square feet of residential, right? And that development needs capital. So the idea was, and incidentally, in Morgan Stanley, I had a chance to be very early when they were just starting the team. KKR, it was again a situation where the business didn't exist, and I had to go there and start that. So it inculcated that desire and that interest to build businesses as opposed to just be an investor. And that's where I thought that okay, now we have done it for these organizations, can we do it for ourselves? So when I left, the idea was to actually build an integrated real estate capital solutions platform. That's how we started Certus Capital in 2018. We have been on that journey since. Yeah.
Did you, I'm sure you must have faced challenges in the initial stages of Certus Capital.
Yeah.
How did you overcome those challenges?
Yeah, and we still face challenges. I mean, we are still 5 years old. And I think these 5 years has been, in that sense, almost unprecedented in a lot of different ways, because not only because it was my entrepreneurial journey. So, of course, when you don't have the umbrella of these big brands, there's everything from finding that office to open that office every morning, to finding your first employee, and to creating your own email setup. Like, it's just not there. So that is one kind of a challenge, which is fine. Every entrepreneur goes through it and you fix it. But also the environment suddenly was dramatically changing. 2000, middle of 2018 we started September, and we started to build an NBFC. It was like a KKR 2.0. We had some investors lined up. Then September 2018 we had ILFS happening. So from a completely capital awash environment, you had an environment where there's no capital. Every NBFC is scrambling for capital. So we had to change 360-degree literally overnight. We had to throw out that whole NBFC building plan out of the window and then start thinking about what the environment is. So we actually pivoted very quickly to then actually helping NBFCs get capital from foreign investors. So the first transaction that we did in Jan 2019 was to sell some of the loans given by DHFL to Bombay Dyeing to this large capital fund, or the opportunistic fund called Oak Tree Capital. That was a 1400 odd crore deal, right? So that was the first thing. It allowed us to get discovered as a new organization, and that was the need of the hour. So we built on that strength. And then suddenly, I mean, we are just 1.5 years in our journey and COVID starts. So then all the work we were doing was with foreign institutional investors, and suddenly you can't travel for almost a year, right? So then again, things changed. By the time we were finishing 2020, markets were starting to rebound, right? So I think we had a lot of these challenges. I think what has kept us in the flow is we had been constantly trying to read what is the need of the market and changing our strategy accordingly. Like today, globally, we are facing a lot of concerns, pressures. Yields have gone up, interest rates have gone up. US just got downgraded from AAA to AA. But domestically, things are going great. So we have over the last 2 years actually started focusing a lot on domestic capital flows as to only foreign capital flows, and that has allowed us to build this new business that we call Earnest.me, where it is channeling domestic capital for the exact same expertise that we had been otherwise working with on foreign capital.
So talking about Earnest.me, could you tell our viewers also a bit in more detailed manner what is Earnest.me and
Right.
where you felt that this platform is required and that's why you launched this platform?
It came out based on a certain belief that we held, and we didn't know how to solve that problem. So what happened was, after going through this 2.5 odd year journey, end of December 2020, when we were sitting back and reflecting as to what it is, where things stand, and what it looks like, we have in fact actually released a research paper, right? And in that research paper, we have come to this conclusion. It was carried by VC Circle also, so it's there in the public domain. We had come to this conclusion where we said that we are ripe for a rebound in the real estate sector, right? At the same time, we only have access to right now very expensive foreign capital, which can solve very small portion of the need. Domestic institutions are fearful at this point in time and they are not participating, and they always had their own challenges in participating in real estate. So we just don't know. There is this $100 billion gap, which is what we sized, and how will that get fulfilled without domestic participation? This is where we, I think, kind of did this paper. We had no idea, we had no thought of honest.me, and we kind of went on our December end breaks. When we came back after that, and I think maybe some of this was at the back of your mind, we said, why can't we create something afresh which will allow domestic investors to participate in the story in a far more meaningful, a far more transparent way, easy way, you know. And thankfully by this time there was a lot of fintech education about managing your personal finances well, education about different products beyond your typical mutual funds and FDs was starting to happen, so we benefited from that. And in that context then we started this development just on hunch, and on this premise of this opportunity we started building earnest.me. It took us our entire 2021 to kind of build the framework, build the underlying tech, build the thought process, build the regulatory framework in terms of doing it. And then we actually went live in January 2022. So, and then I think we have seen a great response. So what we do exactly in that is our basic core competency. Our team, we have a close to 20-member team. All of that, most of that team has an expert background in doing real estate investing and lending in organizations like KKR, Kotak, Morgan Stanley, Piramal, etc., Deloitte, and so on and so forth. So we exactly do what we are doing for our prior organizations, or even for the institutions. Like I gave you the Oaktree example. There are a few other. I mean, as a firm on a B2B side, we have advised foreign institutional investors to the tune of about $1 billion plus. That's the exact same expertise, exact same ecosystem we bring to certain transactions. These are secured debt transactions. We invest this money into real estate companies and projects, and we use our balance sheet to make that investment. Once that investment has been made, is when we allow these deals to become live on earnest.me. We always keep 5 to 10% of these deals throughout, but for the balance 90 to 95%, people can look exactly what the transaction is, what is its return, who is the developer, which city is it in, what is the stage of development, what are the risks, and it is their choice. So the whole transaction happens simply on one OTP. But it is like buying any other bond. Like you can buy a Power Finance Corporation bond today or a HDFC bond today. It is just that these kind of bonds, they're more specialized, they're less liquid. That is what we want investors to be aware of. But they offer returns which is in the range of 14 to 15%. So we have seen a great traction. We manage it throughout the life cycle, and that's kind of what it is. So it's another investment avenue for you, for the investors to explore, and if they like, invest.
So we have noticed in the current, real estate market, now the finance evolution is there, right?
Right.
We are seeing a lot of players getting in this market, especially in the finance.
Right.
What would you say is Certus Capital USP that makes it stay ahead, or I would say stay ahead the game, or we stand apart from the rest of the competitors?
I mean, honestly, I think we are still young, so I wouldn't necessarily kind of claim that, we are the best or anything of that sort. I think what's different though is a lot of quality talent continues to sit in organizations. Many of those are serving only foreign capital, in the sense that most of these organizations, whether it is domestic organizations like Kotak, or whether it is international or foreign organizations like whether it is Blackstone or Brookfield and all that, most of the money that they're managing comes from foreign investors. These are pension funds, sovereign wealth funds, etc., etc. Indian investors actually haven't had much access to teams that come trained from these kind of organizations, right, and offer products which are available to domestic investors, right? So I have personally seen that the learning that we have gone through, because some of these organizations have had much longer history of investing into real estate than Indian real estate itself. in the real estate investing history, which started in 2005. Global investing has been, so they have their best practices, which I think some of the things we have in our team, and we continue to do a lot of work with them. Like in 2021, there was a very large foreign investor which invested 1,000 crore into Embassy Group, and we were advising the investor on that. In 2022, three large couple large investors and Loda Group created a large warehousing platform. We again advised one of the investors in that, right? So I think we continue to have that strength of being able to work with these global investors and then bring that expertise to products that are domestically available, right? So I think that's the thing that keeps us ahead. When we do these engagements, we get questioned, our thought process gets tested against that, which help us improve that process. We are very data driven, so we actually do a lot of internal in-house research around what the trends are, right? uh, so I think those are some of the things that I kind of believe will allow us to make good investments and get them to the right outcome and return.
So talking about data, we are seeing even technology has been,
Right.
hugely adopted now. We are
Right.
seeing digital transformation
Right.
happening in all the industries.
Yes.
As you mentioned, you are data driven. Ernest, me is on the Wiley platform, which is creating a seamless transactions happening. So, how technology are you using when it comes to Certus Capital to make your operation seamless?
Yes.
To make sure that, of course, the data security is also there.
Right.
How are you managing technology in that?
So we use so data and technology in two, three different aspects, right? I mean, data, thankfully, is not just about us. It is about the availability of data for the real estate sector. That has improved a lot. Like 10 years back, there used to be no data services, right? RERA wasn't there, so there was no organized accumulation of data, right? So thankfully, over the last 10 years, what has changed is, one, there are a lot of data services which allow us to mine the right kind of data, and RERA actually is a great source where information about what is the situation of a project, how many units sold, etc., at project level, some of that is available. So thankfully, that data is available. Now it is for us to use, and so we have in-house models where we ensure that a lot of this data is kind of collated on a quarterly basis, right? That honestly anybody can do. It's not that we have created some kind of proprietary tech to analyze that data. It just is that we are a data aware organization. So we collect it, we analyze it, we have teams that do that, and then they disseminate across the organization, right? That's one. But when it came to earnest.me, so the whole idea was that this whole thing has to be very seamless and transparent. Today, the biggest complaints that you would hear of products that came out, people didn't know. I mean, they made a commitment, they didn't know where it went, what happened, what went wrong, and all that. So the whole idea was that, can we make it very transparent? So in that sense, we have created a technology or a base which allows us to present these things in a very seamless manner. The second thing that happens is just the whole process for an investor. In most alternative products, historically it has been cumbersome. Now, not only us, but a lot of other companies are also making it easier, but we are one of them. So the whole idea is that this whole process should be very easy for you. You should be able to log it on your mobile and do it. So the KYC is very simple. Looking at the information is very simple. Just one click will allow you to put in your request. Automatic forms will come to you. You will put in one OTP. You will get a signed transfer, paperwork, and then things just go, right? And then whenever you want to look at what is happening, you have a whole dashboard where you know what is happening with your investment, what is happening with the underlying project. I think that's kind of, and there is a lot of work, like 2.5 years of work that has gone in simplifying this and presenting it. So that's kind of what's.
So your data, your interface of Earnest is quite user friendly. That I understood.
Yeah.
But as an investor, if I'm logging in, what kind of security are you providing for my data or for my particular portfolio? I would say, is there certain security measures that you have made sure that everyone's information, because as you mentioned,
Yes.
and give an example, now we are seeing a lot of products which are being launched.
Right.
Later we get to know the investor or the people, the customer base or database has been shared
Right.
to third parties.
Right. Right.
How do you make sure that this doesn't happen
Right.
in your particular firm?
Right. So I think we have put safeguards on that because data access is there to a very limited set of people within the team and all that stuff. And there are certain firewalls and all that our tech team has put in terms of so that an invasion cannot happen to a certain extent. And we are further improving on that, I must say, right? We also try and ensure that we are not taking too much. We don't take any personal or financial information and all that of our customers and all that, just the basic KYC information. So we only take information that is absolutely necessary from the perspective of executing these trades. So we don't unnecessarily create any info. We never sell anybody's data. Whatever is there is only for our own internal use. So I think those are some of the things that we're using. But I personally think we and industry in general still has a long way to go in terms of just making sure that these things keep becoming more and more robust.
Also, lastly, based on your journey, I want to know when you started Certus Capital, having the right talent, right team is crucial, especially 100%. When you were talking about how you had to change overnight. Right. Having that kind of adaptability to the market trends or the market changes is required.
Absolutely.
So, what kind of approach did you go through when you were hiring or you were forming a team? What were the basic criteria for you that you made sure that it aligns with the vision of the Certus Capital?
Right.
Were there any particular I would say requirement or checklist for the team that you made sure that these people should join in my entrepreneurial journey?
Yeah, no, I think team building is the most important thing, right? Is the most important thing. I have been lucky enough that I've been hiring teams since 2006. Because when I joined Morgan Stanley, I was just the second person to join in India. And the first person is actually my director of investments now, Sahil Shah, at Certus Capital, right? So we went through that process. In KKR, it was the same thing. I was hired, and then we built the whole team. The way we focus on building a team are driven by 2-3 basic things. One, first and foremost, the integrity has to be very, very high before technical competency. The second thing is, yes, we want people. It's an investing business, so you do need experience. So our team, I wouldn't say is very young. I think average age of our team will be having a work-ex of about probably 14 to 15 years. Right? So we wanted to hire initially at least, and of course as an organization it gets younger. But initially you need people who have a lot of expertise. They've gone through 2-3 cycles. They've seen it, and they have lived through it, both in high investing cycles, low investing cycle, managing investment from entry to exit and all of that stuff, right? And honestly, because I've spent almost 20 plus years in this thing, all our hiring has been entirely through reference. So a lot of people are people who have worked with, we had been part of teams together in the past, or these are people who came from references of people we have worked with. So to give you an example, Sahil, who is a director of investments, he and I were at Morgan Stanley together for 7 years. Vishal, who was a partner at Deloitte and joined us. We have closed 3 deals together when I was at KKR, and he was the advisor. So he runs the advisory business, right? Some of our other senior members either were directly known to me from the past or they came through reference. So actually a lot of senior team does come from people who I knew and have had relationships. To me, that's very important. More than where we are going as a business, it is actually emerging as a place where a lot of people aspire to be because of the experience that they can get and the quality of team that exists. And then the younger team, we actually look for attitude more than technical skill set. We look for people being self-managed, so I think attitude, integrity, self-management, and of course depending on how many years of experience you're buying. If I'm hiring 1 or 2 years, I don't actually care the person coming from real estate or investing or any kind of background. It's just their motivations and their hunger and their attitude. When you're hiring mid-level, they may not have done the exact same work, but some familiarity has to be there, and again these attributes. So that's how we kind of try and build.
So in the current fiscal year, What would you say are the ongoing projects which are happening under Certus Capital,
Right.
and how do you envision the future of Certus Capital?
So I think the way we think of the future, and then that feeds into what we do today. So we are honestly very long-term focused. How 1 year goes by, plus or minus, is less important to us as long as the overall business is headed in the right direction. So what we really want to be is a real estate capital solutions provider. We are not a developer. You know, we are not someone who is actively like kind of saying that we will go in and manage the project and all that stuff. We are going to work with developers who we like, who we trust, who have done good business in their past, and we are happy to sometimes support younger organizations. Even in KKR, I have done business with people who are not like having legacies of real estate, and those have been some of our best investments, in fact, right? The way we think about it is, can we be a capital solutions provider? So we have our own investing business and we have the advisory business. Between these two, we look at transactions which are as small as 50 crores to we have concluded transactions which are 3,000 crores and upwards. So what it does for us are two things. One, as an organization, as I said, we are very knowledge and data driven. It provides us a lot of information. Like we worked on that one warehousing trade. Today, investing, we are mostly doing secure debt investing by and large into the residential sector. But by doing that warehousing trade, we as a team are quite educated about what's going on in that sector. And it allows us to make a choice when to start investing our money into that space, right? So we have that space where some of the largest developers in this country are engaging with us for their own capital solutions. We may participate in that, but more importantly, we also have a lot of relationship that will allow us to create that capital solution. And on our own side, we choose the highest conviction themes, and that's what we are really bringing to the investors. Right now, that highest conviction theme is actually private credit into residential, and that's what we are doing, and that is what we are bringing through Earnest for now. And we may also do an AIF. That's kind of what we're contemplating. So as we go along, 4 5 years down the line, if a real estate company has a capital solution, is Certus Capital the first name that comes to their mind? I mean, that's what we want to be. And in that context, this year we are looking at doing maybe 700 800 crores through the Earnest platform, and maybe few large, maybe couple large transactions on the advisory side of our platform. So this is what's going on.
Okay. So thank you for sharing your journey and especially of how Certus Capital's origin story happened. Now let's shift our focus on the changing landscape of finance investment within real estate sector.
Right.
So as of now, the option seems limited. We have banks and we have your NBFC,
Right.
each having certain kind of restrictions,
Right.
and then we have AIF, which has a limited pool. So, how do you perceive these dynamics evolving, and are there any innovative financing mechanism that you believe could bridge over these gaps in the sector?
Right. So I think when you think of capital flows that happen into the real estate, I think broadly you can divide those capital flows into two categories. There are capital flows that has been happening towards acquisition of assets or supporting assets, right? Which is where your Brookfields, Blackstones, GICs of the world has been buying assets in India across the spectrum, whether it is office, whether it is retail to a certain extent, industrial warehouses. I think has been a massive theme over the last few years. Data centers is an emerging theme and all that. And I think this capital flow is fairly robust. A lot of capital is there, and it is mostly international, mostly global capital. And in this space, these guys participate very well, right? And now some of this has been also converted into REITs. We have now 4 REITs already. I mean, 3 on the office sector and most recently on the retail sector, which is the first retail REIT. So that thing is also there, and a lot of domestic capital participation we are starting to see in REITs. So that's one part of the capital, which to be honest, that we have no shortage of, which is a great thing. What it tells us is that global institutions see India as a long-term story, and they're willing to buy and hold long-term real estate assets in this country. Then there is other part of the capital requirement, which is for building real estate, you know, and especially in India, you have probably about 50 million square feet of annual office absorption. You're probably 40 to 50 million square feet of industrial and warehousing absorption right now. Maybe I don't know 5-6 million square feet of retail, but you have almost 350 to 400 million square feet of residential, and that is all development, right? And there has been limited capital to support that. You know, the largest of developers like Oberoi's of the world, of course, are very well banked and very well capitalized, but it's a fragmented industry, right? So there the capital has been limited. In between, there was a time when NBFCs were extremely aggressive, and in fact, there were a lot of mistakes that were made both on the asset side and on the liability side. Investments that were not so great that happened, and also some of the NBFCs were highly leveraged because they were mostly home loan players, and they stepped into development financing, and it causes issues. And after that, RBI has also changed certain rules, so our NBFCs also become a little bit more restricted than what they could do pre 2018, right? So then what happens is that India, which is largely a developmental country as opposed to many Western countries, don't have enough capital to support their development, right? So I think to our mind today, AIFs are stepping into doing so. But what is really, really required is a much wider participation of domestic capital into this space, right? So I mean, to us, what is probably the real trend to watch out for, or the trend as an industry to work towards, is how to democratize the access of this capital, and can we create kind of a debt capital market for the industry. I mean, we are trying to take some steps in that direction. We talked a little bit about earnest.me. I mean, at a fundamental level, it is creation of that debt capital market where you're increasing the transparency of what we are seeking that capital for. We are improving the ease with which that transaction can be done, and you're also increasing the confidence by providing very transparent information about after that investment has been made, right? So to us, yes, AIs will continue to play a major role, right? And domestic wealth, I mean, and we constantly read so much about the power of domestic wealth that is happening. How do we harness that in a more meaningful way for our sector is what I think is very important. And I think actually we will possibly talk about more, but SEBI is coming up with its own regulations. They have been doing a massive overhaul of the AIF regulations. They're coming up with regulations which relate to bond trading platforms and all that stuff. So all of that is very helpful. I'll do that. But to me, AIFs need to come out of the shadow of bad performance that has happened in the past and deliver a different story over the next 5 years. And we need to democratize access and create a debt capital markets for the sector. I think those are the two most important things to watch out for.
So as you said about Oberoi, in the light of the current scenario, what we are noticing is that the handful entities like Oberoi and DLF, they have access to the robust debt capital market in the real estate sector, and that results into significantly having a low cost of capital.
That's right.
So I want to understand that why in the current scenario we still have this limited entities, why we don't have a broader spectrum of having all the stakeholders participate in this kind of scenario where they can also have this access of the lower capital, cost of capital,
right,
in comparison to AIF that I have noticed gives higher capital, right?
Right. No, you're right. I mean, it's a twofold problem, right? First of all, in India, bond markets are shallow. So 98% of bonds in India that are subscribed, and they are by and large subscribed by mutual funds and few institutional investors, they are AAA and AA. Yeah. So there isn't really a market below AAA and AA rated bonds. Now, as I mentioned, real estate sector is fairly fragmented. So many of these companies do not necessarily have that kind of a rating or can get that kind of a rating, right? But that doesn't mean that they are not going doing good business. There are enough and more companies doing good business, and there's a secured thing, right? Also, the other problem that is there is that most of our uh, bond markets are driven by mutual funds, which provide daily liquidity. So there is no ability for them to take true credit products. Like Franklin is a good example. I mean, their funds have ultimately returned most of the principal that they shuttered when they closed those schemes in 2020, and by now, I mean, very recently, they have paid most of their capital. But some of those papers could not have provided daily liquidity, and in a tough environment it suddenly became even more difficult, right? So you actually need to do a bit of a market making here. You need to have some financial companies or organizations which are willing to put their stamp of approval in a way which will provide confidence to the investors to participate in that. And then it is probably at least a 10-year journey before a lot of organizations through that format then themselves become discovered. So if, let's say, take an example, okay, if there is an organization which worked, which issued its bonds, someone like us through earnest.me kind of worked with them to issue that, it got managed well, and then over a period of 7-8 years they did 10 issuances of that nature, and each they were able to do a good job for their investors. By that time they're discovered, right? So that's kind of the, and I think India just need to go through a lot of that landscape before that happens. But I think if they do so, they will be able to reduce their cost of capital for a lot of non NBFC and non bank use by at least 4 to 5%.
But don't you think, as you quoted about Franklin example, we have also seen that, of course, they've started paying out and everything. But don't you think it affects market sentiment on it affects the investor sentiment, and it might even affect the way you're talking about the finance investment should be, more coming in, especially in the real estate domain. When it comes to real estate investment, don't you think the market or the investor will be more still feeling skeptical about the market?
100%. So that's exactly the point. I mean, a lot of investors will be very skeptical. And, like in debt mutual funds, when people look at a mutual fund, they almost treat it like an FD. You can go in today, you can take out tomorrow, you don't expect any capital loss whatsoever, and so on and so forth. But any credit product can actually have a capital loss. If your yields go up, the value of the fund will go down. The other thing is most credit products can't provide the same level of liquidity. So if you are a fund which is starting to see a lot of redemption pressure and you were a credit fund, you will not be able to honor these things. And that's exactly this whole episode of Franklin taught us. So to give you an example, when we have something on earnest.me, we're very clear with our investors. You should not invest unless you have the horizon of, let's say, a 3 year or a 2 year or a 3.5 year, whatever that paper is for. Because, as a sector, we are funding a project. If we are funding a project, that has a life of 3 years. So my financial instrument on that should also have a similar life. Otherwise, there will be a mismatch. And therefore, that education needs to happen. So then when the investor has that education, he comes with that clear mindset, then these kind of accidents can be avoided. And that is what needs to happen over the next few years to build that confidence and education as to who this product is right for what kind of portfolio allocation, how people should think about it, and then grow from there.
So, as you quoted about Franklin, I want to understand your perspective when it comes to, the companies like which we recently saw, ICI Prudential, 360, one private equity fund, where they were. I want to understand what challenges these investors faced. Also, in case where underlying investment, remain unsolved even after AIF being expired, the delay in the payouts happened. What do you believe are the takeaways or the insights that investors also should keep in mind, and even the market should learn from these incidences?
Right. So I will talk more generically. I mean, I don't have a specific view on maybe these one or two companies per se, but in general, the point that you're making is correct that several real estate AIFs and outside of real estate also several other AIFs have run into problem in terms of they're not liquidating their entire corpus by the time the fund term expired, right? And incidentally, in that context, even SEBI has now come up with regulation where if you do not fully liquidate your funds within 1 year of the expiry of the term, either you need to move them into a liquidation scheme or do in specie distribution, which means that whatever is the fund assets, you just give it to the investors in their investment ratio, right? And there are a certain set of things and all that. So historically, I think there are two, three issues around this thing. One is when the product is new, there is the experience of teams who are less. Some products got created and they did not do as well as they were envisaged to do, right? And when you had an investment problem, then there wasn't really a proper market for exiting them. And also, in the absence of this regulation, I mean, maybe not intentionally, but investment managers also may have just tried to keep prolonging the period with the desire to get the best possible value for those investments, right? But to be very honest, I think that may be a reasonable intent. But if, as an investor, you have put money with a certain term in mind, you really want the money to be returned within that term or thereabouts of that term. So I think with this regulatory change, now when people will do it, they know, okay, there is this kind of a deadline. And they will hopefully start working earlier. And even if that means that they have to just liquidate it, whatever is the market clearing price at that point in time, they do so. They do so. And in fact, don't get into this jam where they're trying to take 75% consent of investors, which is any which way the negative thing then, and then are in they're back against the wall, right? So point number one is the first line of defense is having good investment managers, right? So it's like any other investment thing. If you do not end up doing a good job of that, or if the market is a bit early on, some mistakes will get made, people will learn from those mistakes and all that. So I do fundamentally believe that similar to the maturing of a real estate industry in itself, which got matured because of RERA coming in, because of demon happening, GST, plus just the cycle. So a lot of people, everybody thought that they could be developers. They have decided they can't be. There has been a lot of clearance that has happened, right? And industry has become a bit more mature. Same is happening with the investment management industry also for real estate. A lot of people who were in the space, many have decided you need real expertise for it. So either you're developing that expertise or you're vacating the space. So that consolidation is happening there also. Or new firms are coming, including ourselves, where people have done it for donkey's years and now they are using the same expertise to create a new experience. So I think that's really is what going to change. And AIF as a regime, which also came in 2012, now it has also completed over a decade. So actually, SEBI is completely overhauling that regulatory framework also, bringing in some of these disciplines, which will force people to make sure that exits are given, happen, whatever that means from an investment performance point of view. So I think a combination of these two things, hopefully the next few years will have a better experience.
But talking about AIF, I want to understand from you that now the SEBI has given a minimum threshold of 1 crore to begin with, right? So won't this create a bit of, I won't say nuisance, but all kind of players coming in? The market sentiment again can be affected based on who is running what kind of show. This kind of accessibility, do you think it's going to be an advantage or a disadvantage when it comes to real estate market?
No, see, I think the minimum threshold for AIF is 1 crore right now. And I think that is what it has always been at 1 crore. In fact, there's a lot of talk about SEBI wanting to increase that threshold, right? And they've also come up with this concept of large value funds, which are extremely large value funds right now, where single investor has to be at least 70 crores and upwards. So I think in regulators' mind also, 1 crore is actually not a very high ceiling in today's context, right? And therefore, they are bringing in so much more regulation around AIFs, which wasn't the case earlier. So to my mind, it actually increases the regulatory burden on the manager. It will force more serious players to be in this field. Also, the industry, after seeing through the history, is likely to allocate money to people who are more credible, right? So to my mind, I'm not too worried about the quality of managers jumping in diluting. In fact, my personal feeling is it should improve from here on. Also, it has SEBI has aligned certain other practices which related to distribution of AIFs, right? Because originally, like you can pay any kind of fees and all of that was upfront. Now SEBI has mandated how much fees distributors can charge upfront, and it has to be. So that also brings in a bit more discipline in terms of it not being a crazily profitable product to distribute, and therefore avoid some bit of mis-selling.
True. And currently, how we are, you pointed out, the financial crisis which we are seeing,
Right.
or I would say the economy, how it's going for countries like US and UK. I want to know from your expert view, when we see in global countries these kind of scenarios happening, does it affect Cetrus Capital investors in a way, or do you keep that in mind what is happening in other countries and you uh, change the scenario accordingly, keeping in mind how it needs to adapt to what is happening in global market?
So, see, I think that's a good question. I mean, what happens globally certainly has an impact on how capital flows happen to India, right? There's no doubt about it, right? So, if the yields globally has gone up, right, India actually needs to provide a premium over the yields that are available in the US and let's say Europe and so on and so forth, right? So, if the yields there have gone up, they can actually make good return in their home country, so they start demanding more from India, or Indian transactions at similar yields look less attractive, right? So it regulates the flow, or it reduces the flow to that extent, and we've seen that happening. And in fact, one of the conclusion that I was talking about, why domestic capital is therefore important to be harnessed into the sector, is so that we are not heavily reliant on this capital, because then we are at the mercy of how things are happening there, even if things are happening well in India. So we certainly need foreign capital, and it is coming also. But at the same time, if we have twin engines of foreign and domestic capital, it's much better for the sector. We at Certus Capital for sure uh, are quite watchful of that. The very reason of creating Earnest.me was the recognition of the fact that just this foreign capital will not provide us all the solutions that the sector may need, right? So that's where I think we are creating this domestic engine in that sense. And to that extent, yes, I mean, we do need to be fairly vigilant about what are the interests of those capital, especially in some of the larger format deals that we do, where we do directly work with foreign capital, to be aware at where it will actually happen, where it won't happen, right? Because if we keep chasing something which is just very difficult to happen, then it will waste the time of the companies wanting that capital or the solution that they're looking for. We need to be vigilant, but at the same time, we need to keep trying and creating as much domestic solutions as are possibly there.
So government bringing in RERA had, of course, helped the market in
Yes.
terms of not just boost or even regulating the market and helping the consumers, Indian home buyers. And when it comes to finance investment, we have seen now SEBI is also learning and evolving and creating good, compliance and regulations to make sure things are going in the right direction. So when it comes to domestic market, as you are emphasizing on this, what do you believe the government should or the SEBI should look into making sure this particular market, the kind of regulations or the kind of suggestions would help to this market to get that kind of bandwidth or that kind of platform?
Right. So I think I must say there is a lot that is already kind of going on. So you have to give credit to our regulators that at some level, and over the last 4 or 5 years, there's an enormous amount of financial innovation going on, especially led by fintechs and all that stuff, and a lot of products that were not available to general public. They were only in the purview of ultra HNIs, or wealth managed clients, are starting to come to a more retail kind of investor base. And I must say that I think SEBI in that sense has been active in terms of seeing these trends, analyzing these trends, and bringing a framework. So let's say, for example, because of fractional ownership, they have brought this micro and small format REIT kind of a framework, right? They brought that. They've brought OBPP regulations, which is online bond platform regulations, right? So they've brought those things in there. REITs actually has been a very good regulation. I mean, in most countries, REIT regulations have taken years and years to get stabilized. But in our case, I mean, they're not very old as a regulation, and a lot of industry consultation needed to be done. But then we are now seeing that action happening, right? All of these things are financialization of real estate, which I think is the key trend, right? So, to our mind, the only other thing is, because these spaces are still very new, because our bond markets are not very developed, uh, more than the regulation itself, it is the approach to application of the regulation and the consultative process that is required between the regulator and the market participants, that needs to be more robust. It needs to be a little bit more trust driven, and allow some flexibility, some experiments to happen, have a consultative approach, and change that. Not to say that it's kind of not there, but that is what will be required. If that goes missing, some of these innovations will not happen, they will stifle. So
No,
that's
kudos to SEBI is the kind of proactively they are taking initiatives and coming with regulations. Recently, they pointed out how fintech influencers should be
yes,
regularized, and they're still
right,
working on that,
right,
which is very important. And my
right,
question to you on this line is: we are seeing youngsters,
right,
following this social media, Instagram and
right,
YouTube, and following these certain influencers and doing their kind of bets or the investment based on
right,
what these
right,
particular fintech influencers are saying.
right,
And slowly we might even see in real estate, there be
right,
young influencers coming in
right,
suggesting, you
right,
need to not put money in this particular project, or you need not to
yeah,
invest in REIT or something like
yeah,
this. So when it comes to this kind of platform, what is your take? Like, how do we make sure that investors, even the young
yes,
investors, are not getting influenced with the wrong information, are not making the wrong bets, and are, of course, not going into I would say it will be like a black hole of
yes,
spending money like that.
yeah.
What is your take on this?
No, I think that's a very relevant point again, and that's where I think the biggest trap lies. And so really, you have mature products like mutual funds, FDs, and all that. Even in those, I think people need to apply some judgment. Okay, which is a good fund house? There are some more reputed fund houses. Even with FDs, we have seen problems. Banks have gone down, and again, I mean, strong regulatory framework by and large has ensured that a depositor money has not been lost. But we have seen those instances also, and not in very uh, in fairly recent history, right? So at some level, if you are an investor, you got to educate yourself. Like SEBI is there and regulators are there to do their job, but you have to educate yourself to a certain extent. That's point number one. Point number two is, when it comes to newer products, right, or newer spaces. Our space is also a newer space, especially, right? I think the most important thing are two. One is, and this is what I personally do, right? If I'm myself not an expert in an area, but that interests me from an investing point of view, I really want to look at what is the team behind it. How experienced is that team? Is that a uh, well created team with a lot of experience? They've gone through the cycles, this, that, etc. Right? At the end of the day, that's very important. And the second thing is, what is the alignment? Right? Is this just a recommendation platform? Is there own money involved? What is it? Right? So, or if it is still only a recommendation based platform, then what is the history? Like, whosoever is doing that, for that person, his own reputation has to be very, very important, and he must be in that kind of a business for many years and all that stuff. So, I think investing, there is no shortcut. You've got to look at these two, three things. Don't get carried away with the savviness of the interface, and that is hygiene to my view, right? The real thing lies under the hood. So I think those are the key things that people should look at, and these regulatory frameworks will also ensure that there are certain safeguards that are there anyways.
So, your recent investment in Akasa Premium Residential Project, I want to know what kind of checklist first comes in your mind when you're approaching these kind of projects?
Right.
And how did you finalize to invest in this particular project?
Right. Yeah, so it's like pretty much the same playbook that we kind of use. So I think there are two, three basic guardrails that we always use. First and foremost, we're really looking at the counterparty, or who is the developer, and what is their experience, and what is their reputation in that sense, right? So I mean, these guys have done a lot of work, a lot of similar kind of work in that micro market. This is a group called Techno Global and Fortune and Gala, and so they've done a lot of work that gave us comfort. We went, we checked out that work and all that stuff, etc. Right? So that all checks out, right? The bulk of our work is actually doing fairly deep dive into what the approvals are, what the permits are, what the market is, what is the expected cash flow that this project is going to generate vis-a-vis our investment. Do we have substantial covers on it, etc.? So this is very standard. There's nothing rocket science in terms of what needs to be done. But yes, the thoroughness with which it needs to be done is what differentiates a good investment from a bad investment, right? We go through a very thorough thing. What we really liked about this situation was there was a counterparty which is fairly experienced in what we were investing into. They've put in a lot of their own money. Most of our money was going for development of the project. So the exposure was increasing as and when we make that investment. And fantastic, absolutely fantastic location. I mean, it's like stone throw away from the upcoming Ritz Carlton, the 360 West project, very close to the hub of all the new connectivity. Coastal Road is there, Worli Sea Link is there, and all we have to do is about 50 apartments, right? And it provided about a 3x cover on our investment. So so as a combination, this whole package looked quite interesting to us. I think we could generate 15% IRR investment on this for potential investors on earners. So we kind of like that, and that's what that's what we like. And all the regulatory stuff was in place.
Yeah,
Yeah.
I was going to ask that.
Yeah.
You must be making sure that
Yeah.
data approvals and the overall
Yes.
compliance, everything
Yes.
is being
Yes.
followed.
Yes.
So I want to know, when it comes to such investment, how are you making, micromanaging this investment? How
Yeah.
are you making sure
Yeah.
the investment is going in the right direction?
That's right. Actually, yeah. So again, I mean, so all these investments come with a fair amount of control and ongoing monitoring. So so as a process on any investment that we make two external independent monitors. One on the technical side, that is looking through building permits, construction, timeliness of that construction, money being taken from the project is being used to construct the project and all that stuff. So that's an ongoing exercise. And some of the industry leading monitors are the ones that we use. These are the same kind of people I've used during my jobs at KKR and all that stuff, or are being used by other institutional investors, right? So that's one. The second very important aspect of it, and which is also used across the industry by all good quality managers, is escrow controls. So all the money gets channeled through escrow controls, not only RERA, but beyond RERA, whatever releases happens from RERA controlled accounts also happen into other escrow accounts. And from there also, whatever flows down further happens through certain bill approval process, right? Ultimately, all of that is managed by the trustee, but our team basically works with the trustee to ensure that that support is being provided in that sense. So again, I mean, I must say, while it sounds all easy, it's more than what we do. Then this years and years of experience of doing the exact same thing over and over and over again, that has actually helped us hone our own techniques. And it's really, I mean, the thing is that if you perceive a problem, you need to be able to identify that problem at least 1 year in advance, because then it takes that much of time to ensure that that problem does not derail your investment. And then you start working with the counterparty. Ultimately, we are in one way on the same side. He also wants that project to succeed, we also want that project to succeed, and everybody has a happy ending in that sense, right? So that's what we are working towards. And I must say that In most cases, if there is a problem that we identify, we are able to work with our counterparties and borrowers to make sure it does not snowball into a problem that's unmanageable. And that has been the reason even some of our historical investments, which were done in a much more worse vintage, where the sector was actually not doing well, residential sales were not good, and capital supply was so much that you were not getting that good risk reward. Today, actually, we're in a completely opposite environment. So that is the first line of defense in any ways. Where, I mean, 2023, we sold about some 3.8 lakh apartments, which is up from some 2.5 lakh apartments in 2022, which was still a very, very good year. So we have that benefit of a robust cycle and low capital availability, which allows us to have better risk reward. And then we apply all of these principles.
But doesn't this monitoring and micromanaging and all of this, doesn't it miff developers?
It doesn't. I mean, honestly, there also the point is, so first of all, at least we are very clear. We are not there to run their business. They know their business best, right? We are not experts at selling. We are not experts at development. Yes, we have all the agencies who have a lot of expertise in that, but they are there to monitor in that sense. So, incidentally, a lot of seasoned developers, they just understand it. They get it. They know this is the cost of having capital. And idea is to not make it a painful process. Just make it a simple, streamlined process. And for the most part, it just works. So yes, initially when all these things started several years back, it was cumbersome to implement. There were concerns, issues. As investors, we all evolved to understand what's practical, what's not, or how to enforce and implement these monitoring frameworks without actually causing business harm.
No, why I'm asking this because when I spoke to a few developers to gain an insight on what is their take when it comes to AI companies and other companies, they got miffed because of the fact where the companies, investors are telling us, you need to change the website. The website doesn't look that great. It's not gonna get a lot of people coming to the brand. Then they're changing the contractors, then they're bringing their own mandate business agency. But the micro controlling part of all of that is, of course, not setting down good with the developer. They feel like I'm not the developer anymore. It's the investment company or the AI company or any companies that are putting the working capital. It makes them feel that they are just being the puppet and now they have to just go whatever they say.
So, and I agree with, I mean, in the sense, see, if you honestly think about it, there are two kinds of investments. Am I an equity investor or am I a debt investor? Actually, if I'm a debt investor, I'm not even getting paid to do all of that work, right? I am getting paid to make a good investment. I am actually not getting paid to run a development project. And if I partnered with someone who is competent to run the development project, I should not be required to do so. So to my mind, and that has to be an exception rather than your base case. If something has gone wrong, we should absolutely have the ability, and those rights we do retain, to jump in, change contractor, do XYZ and all of that. But that is only when things have gone wrong. Otherwise, I made a bad selection of partner in the first place. So to us, that's very important. Yes, if I'm actually in it, I mean, to give all kudos to Swami Fund, they actually had a mandate to revive projects. And they will be required to do exactly that, because when they are stepping in, these are stuck projects which they are required to revive. So they will have to change the contractor, they will have to change the selling agents, and that's their mandate. But our mandate is very clear. We are not taking anything on earnest where he is a stuck guy or he is not performing or there's a problem. We are not trying to do that. So when I'm not trying to do that, I should not be required to micromanage. I should only be required to monitor. So, I mean, some of those cases could actually be cases where the DNA of the firm is to go into more stressed projects, and then they may want to do that. Or it could be situations where things started well, but then they went south and they wanted to do that. So, but I personally don't subscribe to that ideology that the moment we invest, we start running the show, because that's not my job.
I've been hearing this particular part a lot, because this is not going well with Of course, the smaller developers, the developers who are stuck, it's not going well.
Yeah. And I will give you an example from my KKR days. Okay, earnest business is relatively new. We started last year. But in KKR also, investment that I personally led was almost $700 million there. I don't think there was one project, right, where we necessarily had to go to that point of really trying to run the development. At the very fact, and there were one or two projects where sales were slow. So then we actually actively work with the developer. Okay, what could be the idea? There could be some exchange idea that we brought in, all that stuff, and in consultation with them. So, I mean, honestly, we will do everything that is required to be done to protect our investment if something is not working. I must say that. But at the same time, if we are required to do that, my personal view is we have gone wrong at the outset in selecting the right partner.
Lastly, I want to know, and it's just a hypothetical question, where you're making an investment in such residential properties or in such market, you have spoken about the checklist when you do the thorough research, making sure the compliance radar, everything is followed. But still, if the project gets stuck or still there's a problem, what kind of exit strategies you make sure that your investors or your stakeholders are not getting affected much in it,
right,
and you can make a smooth exit from that project?
So I think so in general, when you're making an investment only, you've got to provide room for markets to change. In general, we end up underwriting time frames which are at least a year more than what normally it should take in a normal market for us to get out. So it allows us that much time to fix things if something has gone wrong, right? So we already buffer that much in typically speaking, right? At the same time, honestly, these are risk investments. Something can go wrong. Let's say tomorrow there is a COVID kind of an event happens, which actually stalled everything for 8-9 months. Now that's exactly where I think we buffer this up. That if some events like that happen, COVID was an extreme event, nobody could even, but something other, we hopefully will still be fine, right? At the same time, if we completely get stuck somewhere, we will have to figure out a way as to who is the new capital provider who can bring in. Can we create some other solution? My own view on this has been, if you have done your investment sensibly and it is well covered from a value perspective, thankfully real estate is not a perishable commodity. Even for, let's say, 6-9 months nothing got sold, those houses were still there, right? As opposed to a lot of companies where if the EBITDA is lost or if that production hour is lost, it's just gone. So thankfully we are in that stage. So I always say real estate financing should not be that expensive. At the end of the day, we are giving money against hard assets. They're not going to run away. So first line of defense, you just make sure that you're identifying the problems early on. If they might appear, then you have solved them within time, right? If the value is there and my time is running out, in all likelihood, I will be able to find some other investors to step in and give me an exit. If somewhere we have gone horribly wrong and we assess the value wrong or the business wrong or the partner wrong, honestly, we will suffer. Our investors will end up suffering. There is no shortcut to it, right? In that sense, in that scenario, we will try and do whatever best we can do to recover as much value as we can. Of course, we have all the legal rights, the enforcement rights, the mortgage, the pledge, the personal guarantees, all of that is there. But if we are in that stage where we're using them, something has already gone horribly wrong.
So Ashish, this particular round is quite famous in Let's Talk Business. It's called Rapid Fire. I don't want you to think too much. I will ask you certain questions, and whatever first thought comes, it's going to give our viewers a good insight about you as your personality or your liking. And let's go with it. So how do you define success? I
mean, it's basically being able to follow your aspiration and feeling happy about it at the end of it.
In one word, what does the future of real estate financing look like?
Democratized access to interesting opportunities for investors at large.
What's your take on cryptocurrency? A trend to embrace or approach with caution?
Approach with caution. I just don't get it.
Warren Buffett or Elon Musk, whose investment philosophy do you would consider to take on?
I mean, investment philosophy, clearly Warren Buffett, though I have a huge respect for Elon Musk for what he has done.
A financial term you wish everyone understood better?
IRR.
So for our viewers to know about IRR.
So IRR is just simply what is the annual total annual return that you would make, which is what is used by finance professionals. But most people who are not finance professionals, they understand coupon, right? And there's a difference between coupon and IRR, because IRR is a compounded version of the coupon in that sense. So if your coupon is 14, your IRR may be 14 and a half. And we want people to understand, because all returns are generally quoted in IRR.
Interesting. I learned one more thing. One book that influenced you the most.
Steve Jobs.
His biography.
Yeah.
Nice. If you weren't in the finance industry, what career would you have chosen?
Tech.
Technology. Like building tech or being part of the product? Like, where
Yes.
would you see yourself?
So that continues to be my passion. I mean, whether it is, I don't know exactly what I would have done, but just building some tech or creating some technology, not necessarily only a coder, but how can you build something new? Like,
Best piece of advice you have ever received?
best was have a view.
Worst advice that you still look back and you chuckle that someone actually gave me this advice.
I mean, sometimes when people say you will miss out, and that sometimes forces you to go against your own intuition, right?
Yeah.
And enough and more time it happens that you're not getting it. You're going to miss out on it, right? And I am sure sometimes I would have even fallen for that advice, but that's when I realized, you have made a mistake, right?
Favorite way to unwind after a busy day?
One is simply watching TV, right? That's one way. Or sometimes if there is an interesting book going on, then reading that.
And what motivates you to push yourself through the challenges you face?
So it's just so I have always been very driven by being able to, more than real estate is my core expertise, but what drives me is, can you create something? And so that's what drives. So even at Certus Capital or Earnest, I mean, it's really that, can we completely change the way this sector is getting financed, bring a new way of doing that what keeps us going. And as long as we keep getting market validation for that, right, that keeps us going. It's not the profits. Yeah, of course we need enough money to keep running, but it's like the market validation and the challenge to create some new way of doing things.
And how would you define your leadership style?
It's very control oriented when it comes to the delivery that we need to do, but it's very self-managed based. Like, all my team needs to be self-managed. If I have to manage someone, it doesn't work. And
favorite quote or mantra that resonates with you?
So one of the favorite quotes that I do apply in my business, it is, you don't make money by buying good things, but by buying things well. It's very, very relevant to our business. So I've applied that consistently, which is, your investments may not necessarily look very shiny, but they need to make money. I mean, so that I think is there. And one of the other, it's not a quote, but it's a learning that I picked up at KKR. And they really used to say, your work begins the day you close a deal. In most cases, we celebrate the closure of a deal, and that makes the headline. But for an investing professional, that's just the start of a journey. So I think that's very, very important for investing professionals to understand.
That's interesting. So tell me your guilty pleasure. It can be even, we expect the financial gurus or experts like you in the investment to be very safeguard with the money. But when it comes to your guilty pleasure, where do you spend the most?
I mean, I absolutely go berserk when we travel. So we don't want to look at the cost when you're traveling, because you just feel that, okay, I mean, that's the time you're taking away for yourself. So maybe that good experiences. So
quickly tell me, the real estate financing scene is shifting. So banks, NBFC or AIF, which one wins your support in the game of real estate finance ruling?
Today I would put my money on debt capital markets.
I knew you would say that. So what do you enjoy most about, what do you enjoy the most about being an entrepreneur?
Actually, there is a lot about being an entrepreneur that's just slog, I must say. But what's most, I don't know if it is enjoyable is necessarily the right word, but what is satisfying is you don't have a box. So if you have a thought and if you have a vision and you're willing to work very hard towards it, entrepreneurship give you that leeway to pursue it. And I think that's in a way the most satisfying or the enjoyable part. Honestly, if you want to be an entrepreneur, you should be totally okay to hang yourself out there to fail. And you can't be disturbed by that potential outcome. So you need to be able to enjoy that journey, and you need to be able to enjoy that freedom of wanting to try what you want to try. I think entrepreneurship is about that, in my view. Success and failure will be determined not only by you, but thousands of other factors also.
So, any hobbies or passion out of work, outside your work?
So what I enjoy most is travel. I used to love photography, but for last 10 years, it's like not happening.
Okay.
And I really enjoy reading about people and companies. So biography not only of people but also of companies.
Nice.
Yeah.
One misconception people often have about entrepreneurs.
I am not 100% sure, but this is my gut feeling. A lot of people think that entrepreneurs are there because they want to make wealth or want to make money. I think that is one outcome, but honestly, if wealth is your only ambition, I don't think you'll be a great entrepreneur, because what it takes to get to that point, there are so many tests you will fail in between, that unless you have that real desire to build a company, build a business, build whatever you're trying to do, you will not get there. There are no shortcuts. Absolutely no.
True. So, what's the most rewarding aspect of your journey with Certus Capital?
I think what I like the most is the way brand is being conceived in the market and the talent pool that we are getting. Because to my mind, if you can have an organization where good quality people are interested in joining, that's your first test, because those guys probably know the market, probably know many companies within that ecosystem, and if they're willing to come to you, that's the test. So to me, that's very important.
So finally, I want to ask you, reflecting on your journey pre-Certus Capital,
Right,
and the path you have taken, what advice would you extend to aspiring entrepreneurs seeking to translate their ideas into an impactful ventures?
so my first point there is, don't do it unless you truly want to be an entrepreneur. Right, I mean, a lot of people I have come across to say, this job I am not loving, so I will try something on that. You should try something because you want to do that, not because you don't want to do what you're doing today. That you must put that self to your test, and if you don't want to be an entrepreneur, then find another job that you like. That, I think, is point number one. Point number, the other advice is, it is going to be harder than you imagine. It is going to take longer than you would have planned for. And I think whatever you may have thought at the beginning, 90% of that will change as you build. So be ready for that ambiguity and be ready for that amorphousness of this whole journey.
So there's also a thing where youngsters feel that finance, watching a lot of finance movies, it's a glamorous job. What is your take on that?
So see, finance, and especially in the West, even more so in India, has been considered a glamorous job. But I think the new crop of youngsters actually are a lot more focused on work-life balance. They have more awareness. They have varied interests and all that stuff. So I am not sure, but yes, finance jobs were always portrayed like 80 to 90-hour weeks, crazy salaries, crazy lifestyle. Like your Wolf of Wall Street. I mean, you see, it personifies things that way, and to a certain extent, it used to be like that. A lot of that, larger than life kind of behaviors have been curtailed over a period of time, but the slog remains. So you decide whether it's for you or not.
Thank you so much, Ashish, for joining us today. It was a pleasure meeting you and learning a lot about you and your journey.
Thank you so much, Kritika. I think it was a very insightful discussion. Thanks for asking all the incisive questions. I enjoyed it.